Let's be honest, the world of investing, the stock market, all that financial news, it can really feel like you're trying to listen in on a conversation in a completely foreign language. It's just full of jargon and acronyms that fly right over your head. You know that feeling, right? You're scanning a financial report or an article, and you just feel lost. Words like PE ratio, enterprise value, and moving averages get tossed around like everyone's supposed to know what they mean. It's so easy to just kind of nod along. Well, you know what? That feeling ends today because in this explainer, we are going to decode that language piece by piece. Welcome to everything you need to know about finance. Now, before we dive in, I have to say this. All of this is for educational purposes. It's a deep dive to give you knowledge, but it is not financial advice. We just want to help you get smarter about this stuff. And hey, if you find that valuable, a quick like and subscribe goes a long way in helping us make more explainers just like this. Okay, so where do we even begin? Well, before you'd ever consider investing in a company, you have to figure out if it's fundamentally healthy. And that all starts with one very simple question. Is the company actually making any money? The first term you'll always hear is revenue, which is sometimes just called sales. Think of this as the big top-line number. It's the total amount of cash a company generates from everything it sells before a single bill gets paid. Just to give you a sense of scale, a giant like Apple can pull in a mind-blowing $123 billion in revenue in just one quarter. It's the starting point for absolutely everything. But of course, a company doesn't get to keep all that revenue. It has costs, right? Salaries, materials, rents, taxes, you name it. After all of that is paid, what's left over is the net income. This is the famous bottom line. So here's the key difference. Revenue is all the money that comes in the front door. Net income is what the company actually gets to keep as pure profit. Now, net income is usually a huge number for the whole company. To make it more meaningful for someone who owns a piece of that company, an investor, we use EPS, or earnings per share. It's super simple. You just take the company's total profit, its net income, and you divide it by how many shares of stock exist. This tells you exactly how much profit was made for every single share you might own. It's a great way to compare the profitability of one company to another. All right, so we figured out the company is making a profit. That's great. But what happens to that profit now? Does the company take every penny and plow it back into the business to grow bigger and faster? Or does it share some of that success directly with its owners, the shareholders? This is a really key question about a company's strategy. And that brings us to the dividend. A dividend is a direct cash payment a company makes to its shareholders, usually right out of its profits. It's basically a little thank you for being an owner. A lot of stable, mature companies, think of a classic like Coca-Cola, are famous for paying them out regularly, like clockwork. It's a very direct way for a company to share its success. This leads us to something called the payout ratio, which really shows you a company's priorities. It's just the percentage of its earnings that get paid out to shareholders as dividends versus the percentage it keeps. Those are called retained earnings, and they get reinvested in the business. A 50% ratio, like you see here, suggests a nice balance, rewarding shareholders today while also funding growth for tomorrow. Okay, so a company can be profitable, it can be healthy, it can even be sharing the wealth. But that's really only half the story. The next huge question is, what's a fair price to pay for a piece of it, for its stock? This is where we get into the art and the science of valuation. And the most famous valuation tool of all is the PE ratio. It answers a really simple question. How many dollars are you willing to pay for just $1 of a company's earnings? So, for example, a $100 stock with an EPS of $5 has a PE of 20. As a rule of thumb, a high PE often means investors are really optimistic and expect a lot of future growth. A low PE could mean you've stumbled upon a potential bargain. But wait, there's a really important distinction to make here. The standard PE ratio that you see most often, it's based on past earnings. And since investing is all about the future, analysts came up with the forward PE, which uses projected future earnings. Think of it like this. The regular PE is the rearview mirror. It shows you where the company has been. The forward PE, that's the map of the road ahead, showing where Wall Street thinks it's going. Now for a number so gigantic it almost sounds fake. Roughly $3 trillion. What on earth is that? Well, that is the approximate market capitalization, or market cap, of a company like Apple. Market cap is the simplest way to measure a company's total size. You just multiply its current stock price by the total number of shares out there. It's basically the sticker price for the entire company if you wanted to buy every last share. But that sticker price doesn't tell the whole story. For that, pros often use something called enterprise value, or EV. The best way to think about it is like buying a house. The market cap is the asking price. But if that house has a big mortgage you'll have to take over, that's like debt. You have to add it to the total cost. And if you find a safe full of cash in the basement, that's like cash on hand. You get to subtract that from your cost. Enterprise value does the exact same thing for a company to find its true takeover price. So now you've got the tools to analyze a company and its price. So now what? Now it's about choosing a strategy, a philosophy that actually fits your goals and your personality. Let's look at a couple of the most popular ways to approach this. On one side of the ring, you have value investing. This is the world of legends like Warren Buffett. A value investor is basically a bargain hunter. They're searching for really solid, good companies that, for whatever reason, the market is down on. They buy them cheap, believing their true worth will shine through eventually. And on the other side, you've got growth investing. These folks are trend spotters. They're not looking for a bargain today. They're looking for companies that are growing at lightning speed, like an early Tesla, betting that their future dominance will make today's price look like an absolute steal down the road. And beyond those big philosophies, there are some really practical tactics. Dollar cost averaging, or DCA, is all about consistency. You invest the same amount of money on a regular schedule, no matter what the market is doing. Buy the dip is more opportunistic. You see it as a chance to invest more when prices fall. And then there's index investing. That's for diversification. Instead of trying to pick the one winning stock, you just buy a little piece of the whole market through a fund. Okay, let's zoom out for a second. Individual stocks don't just exist in a bubble. They're all like boats floating on the same ocean. And the direction of that ocean's tide, the overall market, can lift or sink all of them together. So understanding the market's general mood is absolutely critical. The two primary moods you'll always hear about are the bull and the bear. A bull market is when optimism is high, people are confident, and prices are generally trending up, 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 like that incredible run we saw from 2009 to 2020. A bear market is the exact opposite. Pessimism takes over, and the market falls 20% or more from its recent highs. The 2008 financial crisis, that was a textbook, ferocious bear market. Knowing which one you're in helps you manage your expectations. So how can you actually spot these big trends when there's so much daily up and down noise? Well, one of the most popular tools for this is the moving average. All it is the average price of a stock over a specific period, like 50 days or 200 days. Its whole purpose is to smooth out all that short-term static so you can see the real underlying trend. Is the stock generally heading up, down, or just sideways? The moving average helps you see that bigger picture. Let's make this real. Check this out. We can see here that a stock's recent long-term average prices were, say, $172 and $175. But look, its current price is higher at $180. So what does that tell you? Because the current price is floating above those historical averages, it suggests a bullish upward trend. It's a sign that the momentum is positive right now. Wow, we have covered a lot of ground. From checking a company's pulse with revenue and EPS, to figuring out its price with PE ratios, all the way to reading the market's mood with moving averages. I want you to think of all these terms not as just random facts, but as a powerful new toolkit that you now have at your disposal. And really, that's the whole point, isn't it? These terms, they aren't just jargon designed to confuse you. They are the vocabulary. They're the words you need to understand and participate in this massive global conversation about business, finance, and the economy. This knowledge literally moves you from being a spectator on the sidelines to being an informed player in the game. So we're going to leave you with this one final thought. We've just handed you the dictionary for the language of investing. You can now decode the headlines. You can understand what the analysts are talking about. The real question is, now that you have the dictionary, what story will you choose to read? The journey has just begun.